Good afternoon and welcome this afternoon to Market Movers. We talk about on Friday afternoons what's gone on in the market over the course of the week and what is likely to happen over the course of next week. So it's another great webcast. In fact, the final webcast of the week from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Brent Moores. He's going to be helping me out round out this week of great coaching content. He's a 20-plus year veteran in the financial markets, and he is there to help answer your questions in the chat. And welcome to all of you. Whether you're one of the usual suspects that's here all the time or whether you're brand new, thank you for being here. Thanks for joining us over the course of this week, and we look forward to having you here with us next week as well. And if you're watching this in the recorded version on your own time, great. Thank you for doing that as well. You can also participate in the conversation by leaving questions or comments in the comments section, and we will respond to those as well. But again, happy Friday, and thanks for joining me. We're going to see what's gone on over the course of this week, and probably more importantly, what is happening today in the market. We'll take a look at some of the forces at work and what that intones for potentially next week as well. So we'll see how that goes. And we'll take a look at the economic indicators and things that are still over the horizon. It's a full week of trading next week. We've come off of a holiday shortened week this week. So we'll see what that intones as well. A couple of quick reminders, though, as we get started. Everything we talk about simply for illustrative and educational purposes only. It is not a recommendation. It is not advice. It is not a solicitation of any security or strategy. If we talk about options, remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy or transaction. Remember that spread trading must be done in a margin count. Excuse me. Multiple leg option strategies will involve multiple transaction costs. Make sure that you are aware of the fact that we're using the Thinkorswim desktop software platform today, specifically the paper money version of that. It is a great sandbox for learning. It is not, however, a guarantee of success out there in the real world. Also, we're going to be using technical analysis as well as perhaps some intermarket analysis. No single method of evaluating the market is a guarantee of what's going to happen in the future. They are all theoretical in nature, including fundamental analysis. But Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Past performance is no guarantee of future results. Now, when we talk about stops in this discussion, remember that stops don't guarantee an execution price. They simply specify an activation price. We'll talk about that if we get into that discussion along the way here as well. Our general agenda for this webcast is pretty simple and pretty straightforward. What's gone on over the course of the week? What's going on right now? And how are portfolios perhaps being impacted? And what is to come over the horizon? So let's jump right into the discussion here. I'm going to switch over to the Thinkorswim desktop software platform. And as I do so, this is a good opportunity for me to remind you to click on subscribe there at the bottom of the page. If you haven't done so already, that is a great way to stay connected to the Trader Talks webcast channel, get alerted about new content and new archives that are dropping, and really just stay a part of the community. And it is at no cost to you. Also, you can follow me, you can follow Brent, you can follow all of the great education coaches on X. My X handle is at Ben Watson CS. Brent's is at Brent Moores CS. And the other coaches follow that similar naming convention. The letters CS after our name simply means Charles Schwab. So, one thing to note, if you are following us on X or you do happen to follow us on X, no education coach will ever reach out to you to solicit any kind of weird trading or any kind of purchase request or anything else. We're not going to solicit you for anything to buy or anything else. So keep that in mind. If you do have somebody doing that and they do seem to have the name of one of our coaches, it is in every sense of the word an imposter. So Let us know if you do happen to see that. Hey, let's take a look at, speaking of imposters, it would certainly seem that this particular day today in the market is an imposter when we put it next to what's been going on in the market, because we really haven't had a lot of volatility in the market over the course of the last few weeks. In fact, today's downward move on the SPX is almost engulfing, if you want to think about it from that way, from that perspective in terms of a candlestick pattern, almost engulfing the last really 2 or 3 weeks worth of price movement in the SPX, the broad market. It's not really yet breaking down below that range, but we've talked a number of times over the course of the last 2 weeks, kind of this squeeze range or this narrowing range that the market has gotten itself into. And I talked about this last week. I talked about it earlier this week in terms of kind of this ascending triangle pattern that has been building here. And I talked about the idea that the deeper this market went, the deeper the market this went into the apex of this triangle that was building itself up, the more likely, from a technical analysis perspective, if nothing else, from a technical analysis perspective, the deeper it got into the apex of that triangle, the more likely it was to fail out the bottom of the triangle. And that's exactly what seems to be happening here at the moment. Now, it's not a guarantee that we're going to see a continuation of this move to the downside, but generally when we see an ascending triangle like this, and even if we measure the ascending triangle base from here, generally we're going to see a breakout of that ascending triangle coming anywhere from about 2/3 to about 3/4 of the length down towards the end of that triangle. And we didn't see that. In fact, we didn't see it early this week as we got a big rally up. And we didn't see it last week as we rallied towards this resistance level. So in fact, getting deeper kind of into that coffin corner, if you will, for those of you who are baseball fans, you see that range kind of squeezing and squeezing. And then we see a break both of this RSI trend line and also the diagonal uptrend line of price. We see that move to the downside. Now, this comes as kind of a function of a Friday afternoon and without necessarily any real specific exogenous geopolitical news or anything else, right? I mean, this is just a Friday afternoon without really anything. It's just kind of the conglomeration of everything that's gone on over the course of the week, I think. Unless there was some sort of news event that I happened to miss. And that might be the case, because I don't... Coffin Corner's baseball too, my friend. Yeah, and baseball spring training has just started. But it's the same thing, John. Absolutely the same kind of thing, right? You get into that range, it's hard to get out of. But here's the thing. A lot of things have been changing in terms of economic data, not the least of which has been a change in interest rates. And we'll see how that relates to what's been going on. So let's do this. Let's take a look at a couple of the other indexes, and then we'll kind of relate it to what's going on here. But right now, the SPX, as it closes today, testing kind of right down on that 50-period simple moving average here in this particular case, right? And as we kind of get into this range, the idea is, and that could be it too, Jim, you're absolutely right. Maybe news about what's going on with, with some of the healthcare companies. We'll see if that plays itself out. But that 50-period simple moving average kind of flattening out, acting potentially as a level of support, and we'll see going into next week. But let's take a look at the NASDAQ. And the NASDAQ did just about the same thing, kind of bouncing down from this perspective, bouncing down from again, an ascending triangle. We see a break of that diagonal trend line. But, let's put this into, practical context. On the S&P and on the NASDAQ, we're just barely at the 50-period moving average, right? And if we look at that as kind of our definition of an intermediate term trend identification signal, we've not broken the 50-period moving average. In fact, we broke the 50-period moving average back at the beginning of the year. We broke it again and then had a little excursion back above. And we're sitting back down on it. Now, I think what perhaps worries some people is the size of today's candle. But I think perhaps that might be indicative of a little bit of rotation and maybe pulling things off. And I think Ed has a good point here, right? Maybe institutional investors, maybe retail investors didn't want to hold on to overnight and over the weekend risk. With the way the world is changing, you're right, it is changing fast. Maybe there is that perspective of not holding on to that risk, and then the week to come, maybe the proof in the pudding here, right? I think where there's maybe a little bit more significant change in this particular case is what we see in the Russell 2000. We talked last week about the Russell making that downward move, kind of angling down and bouncing down from resistance at the 50-period moving average. And in fact, it continued to do that. And this was a big engulfing candle today. Again, a big bearish engulfing candle. So the trend here breaking on the Russell 2000, remember that's small caps, that's regional banks, that is 20% roughly technology focus, but it's primarily interest rate sensitive companies. This is what's confusing to me just a little bit here, and we'll talk about that for just 1 second. But yeah, the RSI is changing, right? That's simply an indication of the fact that we're seeing prices closing closer to their lows rather than closing closer to their highs, and breaking those trend lines is indicative of that. It's not down and oversold. It's not at an extreme level of push to the downside in the RSI. If it continues, it might get there, but some traders use a move below that lower line and then a turnaround and move back in the other direction as an entry signal into bullish trades, simply from the perspective of saying, hey, it's sold off enough. Maybe there's some buying pressure coming back in. But across the board here, in the three major indices, look, the RSI is simply sitting down kind of about in the middle of these ranges on the NASDAQ and the SPX. And we've not made a new lower low. That, I think, has to be the context that perhaps we put this into, right? So we have a low, and we have another low, and we have another low, and we have another low here, and we have another low here, and we have another low here. And really, this is just simply, even in the context of the short-term trend, a weekly equal low. So I think you got to put it into that particular context. Now, I don't know that the cycle is reversing. I think maybe, it's premature because we've seen moves to the downside that are bigger than this, right? We go back to the end of the year into 1218. We saw a push to the downside that didn't create a new lower low. It created an equal low relative to the previous price low. So put it in context. If we accept that an uptrend is made up of higher highs and higher lows, that means that every day can't be a new higher high without also seeing higher lows. And this is still a higher or equal low in the context of the trend. So I'm not a bull market apologist by any means in this context, but technical analysis suggests the trend hasn't changed yet, but is potentially being threatened. So pay attention to that. And again, the same thing with the NASDAQ. So just because we see a slowdown, just because we see the RSI moving lower, just because we see a big pullback, doesn't mean the market is tanking. It doesn't mean necessarily that that we're going to see this happen on an ongoing basis. That remains to be seen. We can't predict what's going to happen. But this certainly might be a time that traders could dust off the if this, then that perspective and say, look, if price moves below the 50-period moving average, then I'm going to adjust my portfolio accordingly. Or if a stock moves below a level of support or moves below a significant moving average, then I'm going to exit the trade, else I'm going to wait, right? That becomes kind of the thought process. This might very well simply be the canary in the coal mine. Not necessarily that that is an indication of a long-term condition, but it may be that early warning sign that says, beware, pay attention. Again, as Stephen Sondheim says, and I'm oftentimes fond of quoting, attention must be paid. And I think we are at that point where attention must be paid to what's going on. And that's maybe one of the reasons why you all are in this particular webcast today, because attention is being paid. You're here. Speaking of that, pay some attention to what's going on out there in the chat. There is a feedback survey link available in the chat. If you would do me a favor, do Brent a favor, help us out. Click on that feedback survey, fill that out. It takes a couple of minutes. It is really just 2 or 3 questions, and it helps us immensely because we read that information, we take that information into account, we make these webcasts better. That is your link to helping us make these webcasts better. So let's go back to this one right here, the Russell 2000 for just a second. And, again, I think this is one of those characteristics, right? We start to see this move to the downside. The reason this is a little bit confusing to me is if we go to our studies and we go to add study and we do a quick comparison here, and we do a custom symbol and we do /10Y. 10Y is the 10-year yield. It's kind of the proxy, if you will, for interest rates. Interest rates that drive mortgages, it's interest rates that drive credit cards, it's interest rates that drive auto loans, it's interest rates that to a large degree drive business borrowing. And we can see that objectively, the 10-year, and again, we're using /10Y, not as a futures contract for tradable reasons, but for a market identifier. If you're going to trade futures, remember that futures trading requires separate trading authorization. It's not suitable for all investors. It is highly leveraged and therefore highly risky. So be aware of that. If you want to learn a little bit more about it, I teach a futures trading webcast on Tuesday mornings. And I'll show you where to find that here coming up. But at the same time, the 10-year's been going town, and in fact, it took a move to the downside. If we look at the context behind this move to the downside, this week has been a week of a lot of FEDspeak. We've had a lot of Fed governors talking. Those Fed governors have said a variety of things. We saw Fed minutes. On Wednesday, we saw Fed speakers. So really kind of giving us a cautious stance on rate cuts. That might be part of this. Maybe reducing and kind of reinforcing that reduction in rate cuts from 4 to 2, potentially. Kind of a cautious approach. We saw Fed Vice Chair Jefferson. We saw Goolsbee, Barr, Kugler, all kind of reiterating that same information over the course of this week. And that goes along with some of the kind of data points that we saw as well. Manufacturing turning higher in the Empire State Manufacturing Survey. So this was a significant change. Building permits up a little bit more than expected. In fact, kind of staying relatively flat to where they were, but better than expectations. Jobless claims, though, a little bit higher. The Fed Manufacturing Survey down but higher than it was. S&P Flash Manufacturing PMI significantly higher. So maybe a little bit of rotation into some of that manufacturing and industrial space, but we're not seeing a lot of that. This is what surprises me because the Russell 2000 contains a lot of that small manufacturing power, if you will, from those small cap companies. So this decrease in the interest rates ought to be lifting the Russell 2000, and it is not. And that's what I'm wondering about, because again, remember we talked about this before. In June of last year, we saw a rotation in the Russell 2000 when they rebalanced the Russell 2000 index. The shift was to a greater preponderance of weight to technology and information technology, information communications, which makes it then a little bit more similar to the S&P 500 and to the Russell or to the NASDAQ, and away from maybe more of a dependence on that manufacturing and industrial focus, and even perhaps away from financials. Now, financials also getting hit today. So let's do this really quickly while we're here. Because the other thing that took a real hit this week too, especially today, home sales, excuse me, of existing home sales, consumer sentiment was down, as were retail sales numbers. So that was kind of an indication that maybe there is a bit more caution. Again, attention must be paid. But let's do this. I'm going to shift to a couple of things. Let's go down here to our yield versus the S&P 500. And I want to look at this really quickly. So I want to look at the S&P 500 versus the 10-year kind of on its own. And here's the 10-year, that's the white line. SPX is the blue line. And we can see that whereas previously there's been kind of this opposition of yields and stocks, now we're kind of starting to see these two work themselves back into kind of a positive correlation, right? The correlation is positive at this point, whereas, where we were a week ago, we were still at a slight negative correlation. They were moving in opposition to one another. Here we are a week later, and that correlation has moved from minus 29% to positive 30%. So if you want to think about it from that standpoint, stocks are down as yields are down, and that's not the way things have normally been. So one of these things is not like the other. Things have been moving a little bit differently. We're not back up to that positive, like one-to-one correlation where they move in lockstep with one another. They don't usually, Ed, they don't usually work together. In fact, the correlation more often than not has been in the slight negative to inverse range, to -1. And we're not seeing that right now. We're seeing a little bit of change. And that's a little bit different. Now we saw volatility move a little bit higher here, and we see that VIX made that move to the upside here today, starting to see that push back. Now we saw it bleed off a little bit towards the close. VIX closed in 18 handle. It was up in the 19 range slightly, but that's up significantly from where it was in the 15 range. So more volatility. Now, the way that I always view volatility is that volatility leads to opportunity, right? Because volatility brings two-sided trading. It brings movement as opposed to stasis in the market. So we'll talk a little bit more about that as we get into this. But the other thing that I happen to notice, so this is a correlation between SPX, the broad cap-weighted index, and SPX equal weight. So taking all of the components, weighting them equally as opposed to those that are the largest capitalization, right? And that's kind of what I'm getting to, Alexis, is kind of narrowing this down. So SPX by itself, the cap-weighted, has generally been led by those technology leaders. We've seen that more and more and more over the last couple of weeks. But at the same time, and actually over the last couple of years even, at the same time, we take now SPXEW, which takes out the impact of that cap-weighted Mag 7 technology leadership, and we see both of those going down to about the same degree. And our correlation here in this particular case is now back up almost to that one-to-one or that positive correlation. And that would suggest that maybe the impact of that technology leadership isn't there. These are moving kind of similar to one another. So I think that maybe is the case here, Alexis, and I don't know for sure. But what I do want to do now from here is I want to take a look really quickly at our sectors And let's kind of see what sectors have been impacted to the greatest degree. So we know that given the economic data that's come out this week, manufacturing sector saw a positive increase. Services sector saw a move to the downside a little bit. The housing and home builder confidence dropped, and the labor market and consumer sentiment dropped a little bit, right? So that kind of plays itself out in where maybe some of that rotation is happening. So we're going to go here, and I'm going to change this to my grid that I have built, which is our SPX sector index grid. And we'll just go through each one of the sectors. Now, we do happen to have a watch list. Somebody asked me this question last week about the watch list. So if you go to the Market Watch tab and you go to quotes and you go to the public watch lists, and you come down here to, it's in S, I think it is right there, public watch lists under S, it is S&P 500 sector indexes, and you'll see those sector indexes here that I'm using for this particular chart. So we'll just go through these individually. And we can see that the energy sector is down today. Again, the energy sector isn't entirely crude oil, but we could do that really quickly. Let's go to our studies. And we'll add studies real quick, and we'll just do a really quick custom study comparison to /CL. And again, we're using the futures market as a market indicator, not as a tradable instrument in this particular case. So we're going to use crude oil. We can see that now that energy sector had been diverging a little bit from crude oil prices, as it can do. But oftentimes it moves generally in correlation, but you saw the energy sector rising while crude oil prices, that's the purple line, were falling. Now we're kind of seeing them maybe kind of coming back together again, with the energy sector moving down today significantly, along with that drop in crude oil. Now, inventory numbers were pretty significant this week. We saw a pretty significant build in crude inventories and moderate builds in gasoline and heating oil, the distillates, the refined components. That's an indication of decreasing demand, and even with increased geopolitical stability, potentially we see that the energy sector kind of backing off. There's not a lot of risk premium here, geopolitical risk premium, neither in the crude oil price nor in what's going on in the energy sector. That's telling. But one other thing to think about, and I just saw this before I started, so I didn't have a chart to look at, is the fact that the Baker Hughes rig count numbers went up by +7. So we saw a net positive gain in new drilling rigs, which would suggest that there is some anticipation of growth in the space, and that benefits potentially the energy sector and maybe pushes pressure down with increased supply on crude prices. So that being said, if we think about it from that standpoint, +7 relative to what the increases in rig counts have been over the course of the last year or so, 2 years, that's a pretty significant increase. So that's something, again, to pay attention to and keep an eye on. But that's our energy sector. So let's move forward and let's take a look at materials. Materials making that move to the downside. And again, a lot of this has to do with perhaps demand issues in terms of materials, specifically in the home builders. And that's kind of that forward looking. So even though this has sensitivity also to crude oil prices, it also has a lot of sensitivity to the home builders. Industrials. And again, industrials also incorporate technology. Well, industrials incorporate, to a certain extent, sensitivity to energy prices, but it also incorporates a lot of manufacturing, right? It's not all entirely manufacturing. Industrials is not entirely manufacturing. I want to do this really quickly. We know some of the things that have been changing in the airline industry in the last couple of weeks, couple of months. So what I want to do is I want to come up and I want to put that comparison study on here again, and we'll put a custom symbol on here. And I want to do that comparison with DAL, Delta Airlines. And so you can see industrials have largely been tracking, well, Delta Airlines largely been tracking the broader industrial sector. Delta Airlines down, industrials down. That would suggest that there's wider spread impact to the industrials than just in the manufacturing space. Delta also kind of incorporates some of that service and consumer discretionary aspect. And so we're seeing that impact maybe coming home to roost. Now, breaking below the 50-period moving average in this particular case, that might be significant. We've seen it above that for some time. Consumer discretionaries, though, this has been getting hit over the course of the last few weeks, and we kind of see that intermediate term downtrend going on. And with today's retail sales numbers coming in a little bit lighter than expected, an impact to some of the discretionary, and where we're seeing some significant impact to the discretionary has been coming in place of things like restaurants and fast food and those types of things, which have been seeing some changes. So let's kind of take a look here really quickly. I'm going to do this. We know that we've seen some pretty strong restaurant moves in the last little while, both to the upside and to the downside. One that we'd been looking at was Brinker International, right, with Chili's and some of their other brands being very strong. So I'm going to come up here to our studies. We'll go add study, compare with, and I'll do a custom symbol. And we'll put on here our custom symbol EAT, and we'll take a look. And you can see again how Brinker International has largely been tracking the broad consumer discretionary sector, peaked out, and we saw Brinker start to fall. EAT is the symbol, EAT. And we can see that purple line kind of leading this sector to the downside, suggesting that it is an impact to spending. Consumer sentiment is down, retail sales are down, restaurant sales are down. Again, a little bit of uncertainty going on perhaps in the market. And also a big part of this, if you want to think about it, is what impacted Walmart. So I'm going to do one thing really quickly here. I'm going to come over here. We're going to change our comparison. Eat's a good comparison for restaurants, but let's put in here WMT, Walmart, and we'll take a look at what's going on in Walmart and apply an OK. And you can see that, again, that was largely tracking the broad consumer discretionary space. Big downside move in Walmart in the last couple of days post the earnings announcement, also helping to drag down this consumer discretionary space in terms of retail. So you're starting to see some of that impact there. Now let's move through into consumer staples. And this is an area where, if you want to think about it in terms of where's that money going, if it's rotating out of technology, if it's rotating out of consumer discretionary and retail, if it's rotating out of industrials, where might that money be seeking performance? Because ultimately, that's what investors do, right? They seek performance, price appreciation, dividend yield. John says, wouldn't you compare Walmart to Staples? You'd think that, right? But Walmart generally isn't necessarily a Staples retailer. They have become in kind of that rotation, and the Schwab network has talked extensively about it this week, according to, based on their earnings announcement and earnings forward guidance and things like that, that Walmart has a foot in both, even though it's listed in consumer staples in terms of its interest, its significant sector. Those things change and market perceptions change. Now, remember, the Schwab network, brought to us by our media affiliate, Charles Schwab Media Productions, was a separate affiliated company. But I would encourage you, if you want to see what's going on a weekly basis, on a daily basis in terms of news flow, the Schwab network is a great place to go. You can find it right here on the Thinkorswim platform. But Walmart impacting consumer discretionary probably more so than impacting consumer staples. We're seeing a rotation perhaps into staples, and I'll look at some of those staples here in just a minute, because we'll take a look at where maybe some of those moves in one way or the other are going. And then we're going to pop back over here to healthcare, and despite the news, healthcare remaining relatively strong. So let's do this. Let's do a comparison, and we'll do add study, compare with, custom symbol, and we'll do UNH, United Healthcare. And we can see United Healthcare, despite the fact that we see United Healthcare making a move to the downside, the rest of the sector still remaining fairly strong. Okay? Still remaining fairly strong. Financials, on the other hand, starting to see that move to the downside. And this has been one of the strongest sectors, surprisingly. But again, this is maybe going to be one of those things that is interest rate sensitive. So let's do the same thing. We'll add, compare with, custom symbol, /10Y. And we use that as kind of that proxy. And you can see the financials don't always move in lockstep, but financials have kind of been flattening out as interest rates have been going down. And again, many of the financial revenue streams for financials are tied to interest gained on assets under management. And if the interest rate that is being received is going down, that's going to have an impact to their revenue stream. On the other side of that coin, though, if interest rates are going down, also some of these financials that fall in this particular sector are sensitive to borrowing activity. And so if interest rates go down, borrowing activity maybe goes up a little bit, right? Let's take a look at information technology. We see information technology breaking the 50-period moving average. It had been moving to a higher low, to a lower high. Now breaking below. Let's do our comparison here really quickly. Add study, compare with, and we'll just compare this to NVIDIA. And we'll click on OK here, and we can see that NVIDIA has been driving this sector mostly. NVIDIA moving to the downside may be one of the reasons why we're seeing a move to the downside in the sector broadly. So a comparison there, giving us perhaps some perspective on that. Communication services. And this is an interesting one because also this incorporates some of the streaming services. So let's do a comparison here. Add studies, compare with, and we'll compare with NFLX, Netflix. As goes comm services, so goes Netflix. Generally, we see it moving largely in the context of that broad communication services sector. Netflix down over the last couple of days, maybe leading to some downward movement in communication services, right? And utilities. And utilities kind of cruising along here, just chugging right on along, and maybe at that breakout point. So we've got two areas where there's some strength. Consumer staples and utilities. And because we're seeing strength there, that would suggest to me that maybe there's that rotation into some of those defensive stocks. So the last thing I want to do here is look at real estate in this area and seeing still some strength there. That might have to do with the rates going down a little bit. But I wanted to do this. I popped open my watch list, and this is a bull flag watch list. And again, anything that we put in a watch list is simply for illustrative and educational purposes only. This is stocks that have been moving up and then have pulled back and now are showing a breakout, either a testing potential breakout or a breakout condition today. So I wanted to look at the stocks that were showing breakouts today in light of what's been going on in the overall market. So I'm going to change my grid to my single grid. There's my single grid, and I want to look at some of these stocks. If you look at the sector that these stocks are in that showed that breakout today, utilities, consumer staples, utilities, consumer staples, utilities, consumer staples, utilities, consumer staples, utilities, healthcare. This is a rotation into defensive stocks, right? This is a rotation into those defensive stocks. Let's see what that looks like. So AWK, making a move to the upside off of a double bottom. Baxter, making a move off of a double bottom and an earnings announcement. CNP in the healthcare space, big move to the upside, breakout of a resistance level and continuing to move higher. Campbell Soup, reversing off of an inverted head and shoulders or a double bottom, maybe testing a level of resistance here. D in that utilities space, making the move and breaking out above previous resistance. ED, Edwards Life Sciences, making that break out above. Again, continuation in these cases. Kraft Heinz, reversal off of a double bottom, kind of a skewed double bottom, and breaking above a resistance level. Mondelez, people eating their Oreos here. Maybe that's the Post Malone Oreo hype kicking in here, but off the earnings announcement, making that move to the upside. And Smucker's Jam also making a big square W pattern breakout here in the upside. So my point in kind of wrapping this up, in pulling this together here, is evaluating what's going on with the sectors can give you a sense of where there is some individual strength. Now, does that mean that these are going to continue? Absolutely not. We take a look at where some of these are testing, and you see some of the consumer discretionaries where that's testing. In the energy sector, some testing to the upside. Communications, testing to the upside. Technology, testing some of those breakouts. So this isn't necessarily where that rotation is going to stay. So it might be a rotation out of the leaders and into some of the potentials in the space. So that's also something to pay attention to. So what I'm going to do really quickly, since I've built this scan and many of you asked for it, I'm going to go over here to the scan tab, and I've built this scan before, and I'm going to pop right over here, and I'm going to share this scan query with you. Actually, let's load it up first. Let's load up our scan query. It is our scan query bull flag. Now, remember, when we share anything, when we share any of these watch lists or chart grids or scan queries, this is something that is not guaranteed as to time or as to accuracy. It is an example, an illustrative example only. These are not recommendations. And remember, in paper money, scan queries that incorporate study components do not work. So this will work in a live account only. So I'm going to go ahead and just with that caveat, I'm going to go ahead and share this scan query. We'll call it bull flag scan. Whoops. I used to use this in my trading flag patterns class quite a bit, the webcast that I used to teach, and we'll go ahead and we'll share that out here in the chat. Again, remember, that's not guaranteed. And I'll put that also in the description of the webcast today. And the other thing that I'm going to share with you really quickly here is my watch list column here, and that is my breakout column. So I'll go ahead and click on that, and I'll share this as a breakout column header. And we'll go ahead and share, and I'll put this out here as well. And I'll put that in the description as well. So that's where you can find that information and that scan. But as we look forward to next week, pay attention to the calendar. As we switch the calendar forward, it is going to be kind of the last big tranche of earnings announcements in this season. But we also have some technology stocks, some late retailers reporting. And if we look at our Econo Day events, we've got PMI coming up, GDP focus, PPI coming up next week. So that's going to be some driving factors. If you want to find more information and more resources, come on over here to schwab.com/coaching. And if you want to dig into the archives, come down here to the Trader Talks webcast channel, subscribe if you haven't already, and go ahead and type in sector and whatever you want to find in here. Connie Hill teaches a great webcast on an ongoing basis on market and sector analysis. So you can find some great resources right there as well. So good opportunity for you to do a little bit more of your own research. Guys, thanks for joining me today and for summing up this week with me. My thanks to Brent Morris. My thanks, of course, to our great production staff for helping out with this as well. And as I sign off every Friday, keep your arms and hands inside the ride at all times. Hang on and have fun. We'll see you next week. Take care, everybody. Bye-bye.